Welcome to the Capital Spotlight, where we interview institutional capital allocators to learn more about their strategies, sponsor and investment criteria, due diligence process, and asset management practices. I'm your host, Rob Beardsley, and today we're having a discussion with Zach Dover with Eastham Capital. Thanks for coming on the show.
It's a pleasure being here. Thank you, Rob.
Very cool. Well, to start, let's just dive in so we can learn more about what you do and what does Eastham Capital invest in, and who do you partner with?
Yeah, sure. It would be my pleasure. And again, thanks for having me. So Eastham Capital is a private equity real estate fund. We're based in Boca Raton, Florida. We were in Boston. That's where the company started, but we moved the company to Florida in 2015. We invest in apartment communities all across the country. And right now we are investing our fifth fund. It's a $215 million fund. It's made up of roughly 400 investors or so. We come into deals as the limited partner on deals. We are the silent money. And we can write checks anywhere from $1 to $15 million. And across all of our funds right now, we own about 10,000 apartment units, a lot of deals in the Southeast and the Midwest, in such states like Texas and Florida, Georgia, Indiana, North and South Carolina. Those have been our hot markets throughout the years. And we've partnered with over 10 joint venture partners, and we're always looking for new deals and new partners to work with. And we can write checks anywhere from $1 to $15 million. So if you're looking for limited partner money, anywhere from $1 to $15 million, feel free to email me or call me anytime. Always happy to speak. So that's a quick 2-minute overview on Eastham Capital.
That's great. So you said a couple times there 1 to 15 million, which I think is interesting, and we should talk a little bit more about that
Sure.
because some people could look at that as pretty flexible, right? Some capital providers are 5 million up, or 5 to 10, or 15 million plus, and I think 1 to 15 is a pretty big range and could put you in quite different types of deal profiles. So how has that worked for you guys, and have you seen big differences in smaller deals versus big deals? That's something we see personally a lot, is just the returns are very different.
Sure. There's less competition for the smaller deals. There's a lot more Eastham Capital and institutional investors chasing the larger deals. So when we write checks for 11 or 12 million dollars, there's a lot of groups chasing those deals. But I'll give you an example. We wrote a check in December for about $1 million in Indianapolis, and there was not a lot of money chasing that deal, and we're going to have tremendous returns. We performed on the deal. So less competition on the deals. Here's the other side of the coin. Although there's more value to be had on the smaller deals, I will tell you this. So I also am the in-house legal counsel for Eastham Capital. It is just as much legal work to write a check for $1 million as it is writing a check for $15 million. So it's a lot of work still doing the smaller deals. But look, if you can find some tremendous value, we would be happy to write a check for $1 million. And I don't think there's a lot of groups like ours who will really write a check for $1 million, and we still will.
And when you are writing that $1 million check, are you typically the sole LP in the deal, making up 80 to 90% of the equity, or are you comfortable or prefer to be one of a few? How does it work
Yeah,
for those
so
millions?
good question. On a check that small, on $1 million, it would just be too much work if we were not the only limited partner on the deal. On that deal specifically, I believe it was an 85-15 split, or where we put in 85% of the money. So the total equity check was a little above $1 million. We wrote a check for $1 million, and we put up 85% of the money, and the sponsor put in 15%. But as we do larger deals, let's say the equity checks, like closer to $15 million, maybe at that point, we'd be more comfortable writing or co-investing with another limited partner. I will say that there is a catch with us, though, and I was going to get to this later. If we do have a co-investor, we have to have major decision rights. So we have to have the major decisions to buy, to sell, and to refinance.
Definitely makes
And
sense.
that's just because of our fund documents and the way we're set up.
Right. your investors are trusting you, and in turn, you have to be in a position of control so that you can actually have that control that your investors are trusting you to have. So,
And although we do have the major decision rights, I would say, so we've sold right now about 50 deals across. So we started the company in 2007. So over the last 13 years, we've sold about 50 or 55 deals. And I can think of only 2 times have we gone to our partner and said, hey, we think it's a good time to sell. The other 53 times, it's the partner coming to us saying, hey, Eastham Capital, we want to sell. We think it's a wonderful time for XYZ reasons. But twice we went to our partner and said, hey, we think it's a good time to sell. And on those deals, we almost 3x'd our money on those deals. So it was a wonderful time to sell. We were totally right. But usually it's the sponsor telling us when the good time to sell is.
so going back to the different deal sizes, do you guys, when you're analyzing the deal, explicitly look for higher return thresholds for the smaller deals because simply, like you said, there's fixed costs that don't scale, or that?
Yeah, absolutely. If you're going to write a check for $1 million, it better be a fantastic investment. Because the amount of work is just as it's the same work doing the $1 million check as opposed to the $15 million check. So the deal that we underwrote in Indianapolis for $1 million check was going to be a phenomenal deal.
So going to the other side of the spectrum, the $15 million check, that's going to be very much institutional real estate. It'll be, if we're talking multifamily, it'd be something like 150 to 250,000 per unit. So good real estate.
So I'll interrupt if I can. So the largest check we wrote recently was about a $12 million check, and that was in Atlanta, Georgia. And it was actually a 3-deal portfolio, but all the deals are practically next to each other. So I consider it one deal. And that was just such a unique play. The occupancy going in is about 70%. It was totally mismanaged, needed a ton of renovation. I think we bought that deal for about $70,000 a unit, and we're all into it for about $90,000 a unit. And it's about 500 units-ish. And again, we're putting a lot of work into it. So that was an instance where we're still writing a large check, but it's that traditional value add with extremely juicy returns. But I would say that is the rare exception. And you're right. If you're writing a larger check closer to $15 million, you would think you're buying something for $150,000 or $200,000 a unit, but it's not always the case. There's always unique circumstances.
So you definitely got the best of both worlds on that one.
Yeah, and again, those are the rare deals to find, and those are the deals that excite me as an analyst and as head of acquisitions at Eastham Capital.
Yeah. So last question about this, and then we'll dive into some of the other topics.
Sure.
For your top end type deals, basically that are least amount of risk, largest check, what would be the lowest return? And this is pre-COVID, because obviously we're all still trying to orient ourselves in this post-COVID world, but pre-COVID, what was your lowest return requirement for just the deal you wanted the most?
So we're looking at 2x our money over a 5 to 7 year hold period. So there was a few deals that we were taking a look at. So we like to hit 10% cash flow by year 3. And there was a few deals right before COVID that we were seeing, okay, it's cash flowing 8-9% by year 3, but there should be some really nice appreciation at the sale. Again, traditionally, we're looking for over a 10% cash on cash by year 3. We were starting to maybe think about, would we accept an 8 or 9% return if we can certainly double our money over 5 to 7 years. So that was probably the lowest we would take a look at.
Got it. And when you're factoring in that 10% cash yield, how do you evaluate interest only, right? Because theoretically, I could go in there with full term interest only, maybe lever up with some additional leverage and really squeeze on a current yield basis. How do you look at that in terms of amortization, interest only?
Sure. I love interest only. If you're getting 10% money back, that's 10% money in your pocket. So hey, look, the more IO, the merrier. And right, if you are getting, let's say a 10% IO return is maybe the equivalent to a 7 or 8% return if it's amortizing, and totally get it. But I'm all for getting your money up front. I know you'll get that money back one day when you sell the property, and totally get that thesis, but I'm all for getting your money back right away. There's nothing like having money in your pocket.
And is there
So
any things in your fund docs that guide or limit your max leverage?
there's not. But I'll tell you this, we're not going to be super aggressive. We're not, I don't think we've ever done a deal um, more than like 80% loan to cost ever.
Right. Okay. So let's talk about how you're approaching acquisitions today.
Yeah, so it's a good question. So our company strategy, so the company started in 2007. And before that, the principals at Eastham Capital have been investing in real estate since the early 90s. So before they were the limited partners on the deals, they were actually the general partners on the deals they were buying. So we like to say at Eastham Capital that we're real estate guys doing this fund. We're not fund guys doing real estate. So we really had the same strategy at Eastham since the early 90s. And this is going to be crazy to say, but we actually have the same strategy and the same threshold of returns as we did before COVID as we do today. I may be one of the rare exceptions saying that. Um, with that said, we saw over 100 deals in our office at Eastham Capital from January to March. And when I say deals coming into the office, it's people calling me up saying, "Hey, Zach, I have this deal I'm buying. I'm looking for equity on the deal. I'm looking for $1 to $15 million. I love this deal for XYZ reason." And so we saw 100 deals, and we did 0 of them. So we were extremely picky beforehand, and we're certainly extremely picky today. And again, going back to a return threshold, we're looking to double our money over a 5 to 7 year time period and looking for that 10% cash on cash return by year 3. And if we have some IO, that's okay as well. But we're still looking for the same return threshold today as we were 3 or 4 months ago. I personally think that pricing was just extremely inflated before this happened. And this was just the balloon. Hopefully the balloon has popped, and hopefully some sellers will expect some realistic prices, and we can make some numbers work.
Absolutely right. Hopefully your return targets become more realistic, and instead of looking at 100 deals to maybe get 0 or 1, you can start to look at 100 and get 2, 3.
Yeah, and I'll share with you some of what I've heard the last month or so. So back in January, a lot of deals, and I'm going to make this very immature, so I apologize if anyone's listening and they're like, "This is very elementary," but a lot of deals would go through a bidding process. So a lot of groups be bidding on deals, and let's say there's a deal that's blasted to the entire industry, and let's say a deal gets 30 bids on the deal, and then there's a best and final, and the top 6 groups are in the best and final. Then there's another best and final. Now there's 2 groups left, and there's buyer interviews, and the price keeps going up and up and up and up. I've heard the last month or so there's really no more auctions, and there's no more best in finals. There's kind of, you put your best offer in, and if the seller likes it, great. If not, it goes someone else. So I think for the time being, there's really no more best and final, quote unquote. So that's really been an adjustment the last few months. So if we can, Rob, going back to the strategy and something I meant to bring up about Eastham Capital, and interrupt me if I'm rambling. I'll give you the quick 5 rules in regards to how we invest, and you can feel free to ask me any questions on any of the 5 rules. We've had these 5 rules now for a very long time, and I'd be happy to share them with you. So 1, we only invest with groups who are local to the market they invest in. For example, I know that you're an investor in Texas. So let's say you show me a deal in, I don't know, in Portland, Oregon. It's probably not going to be a fit if it's your first deal there, if you've had no track record of success there. This may be a shock, but we think all real estate is local. I can tell you what's happening in Delray Beach, which is outside my house, but I can't tell you what's happening in Portland, Oregon. So, and you certainly know the Houston market quite well. I know that you invest there, so that would be your market. 2, we do require skin in the game. And we can talk about this rule later on. I know it's one of your future questions, but we do require skin in the game from the sponsor, and different sponsors have different comfort levels of skin in the game, but we can talk about that later. Three, we have been traditionally self-management preferred. We've never worked with a group that hires outside third-party management. Not to say we wouldn't. We do have a goal to raise a new fund next year or later this year, hopefully a $400 million fund. And maybe with that fund, we've entertained, hey, maybe we'll look at deals from groups that hire third-party management. But up until this point, we've only worked with groups that do self-manage. Four, we like to say that we fix properties, not neighborhoods. Again, we fix properties, not neighborhoods. And I had way too much free time about 3 years ago and actually trademarked that line. So if anybody wants to use it, they're going to have to send Zach Dovner at Eastham Capital $1. But we look at things like the census. We look at single-family home data, crime stats. We're not going to go to super tough demographics, but we're certainly not afraid of blue-collar demographics. And five, we're looking to double our money over the life of the investment through strong cash-flowing assets. So those are the rules that we made, or the partners of Eastham Capital made back in 2007. Again, I started in 2012, but I've been giving those 5 rules almost every day of my career at Eastham Capital.
Love it. That's very succinct, and I think it covers a lot of the important bases in terms of partnerships and buying deals that make sense. So that's very cool. Go ahead.
Yeah, and I would say too, talking about downturns and a lot of the rules are logic. So one of the reasons why we're looking for deals that hit 10% cash flow is because let's say we have a downturn, such as a COVID-19 or another crisis, and our cash flow takes a hit. If our goal is to make it 10, and let's say the cash flow goes down to a 3 or 4 or 5% cash flow, that still beats most investments. We still live to fight another day. Or a lot of these other investments that are not projecting hit 10, let's say you were projecting hit 5% cash flow. Okay, well today you're hitting 1% cash flow or no cash flow, or you're losing money and you can't live to fight another day. So that's kind of the rationale why we're looking to hit these 10% returns by year 3, even with the IO.
Yeah, and with that 10% metric, do you have additional debt service coverage ratios that you're trying to hit as well? Because that's also sort of a risk metric, right? You're using your 10% cash on cash as a risk mitigation tactic as well as a benchmark. Do you have specific risk metrics as well?
Honestly, no. I'll give you the one metric in terms of the debt service, no, but one metric that we take a hard look at, and it's what are your rents versus what are you buying for? And it's actually it's pretty simple math. Let's say you're buying an apartment complex for $100,000 a unit, and the rents are $500. I can tell you very quickly that that's not going to work. But if you're buying something for $100,000 a unit and the rents are $1,500, that deal most likely is going to work. So just taking a look at the rents versus your purchase price is a quick back of the napkin math. And that's something we take a really hard look at. And although it's very simple, it's a test that we've used and thus far have been successful using that strategy.
We surprisingly look at that a lot too, because we'll obviously do very in-depth analyses. We'll, like you said, research the demographics, the market and stuff, and then we'll come to an end result and we'll look at the numbers, and the numbers might end up totally upside down, negative IRR and terrible deal. And we're just kind of looking back at everything and wondering, why did we miss something? Why are we getting such bad projections? And then we just kind of sanity check it and look at, well, they're asking $90,000 per unit and the rents are $600, $700, and it's never going to work.
And it's honestly, it's elementary and it's simple, but it actually really works. And just switching gears a little bit, I was on the phone with someone earlier today who has a multifamily portfolio, and also they have some hotels in their portfolio. And I just could not be more grateful today that we're in an industry like multifamily where people need a place to live and people are paying their rents, because in their hotel, they have hotels and they have retail as well, they were telling me, but in their retail portfolio, they're 50% collected today. 50% collected. And That's terrible. So we certainly should be grateful that we're in multifamily at a time like this.
Agreed. And is that, you are so specific just to multifamily? Is that just your fund, or is that just the ethos of the founders
Yeah,
of the
so our
company?
fund, our fund only does multifamily, and it's a great space to be. What do people need right now? They need a roof over their head, they need healthcare, but they certainly don't need hotels or retail or office space. I'm very curious to see what happens to office space after all this. I mean, a lot of people are working from home and having success. I mean, what's really the need for office space for a lot of companies? So if there's one quote unquote protected class, it's certainly multifamily.
I like it. Going back to acquisition criteria markets, do you have any rule of thumb for incomes and things like that? For example, we look at, for us, less than really $35,000 in immediate median income is somewhat of a red flag for us. What are those types of metrics that you look at?
So the two big things with us are schools. What are the nearby, and it's all relative to what you're buying it for, right? If you're buying something for $20,000 an apartment unit, maybe you don't care as much about the schools. But if you're buying something for $150,000 a unit, there better be some really strong schools nearby. And two, the other big metric for us is single family home values. If you're buying something for 100,000 a unit, I really would hope not to see the single family homes next door selling for $100,000 a house. I would love those homes to be selling for $500,000 or $400,000 a house. But if I'm buying something, and I'll give you an example. We bought something in Fort Wayne, Indiana, about 6 months ago. We paid $13,000 a door for it, which is a great price. And we're putting in about 25 a door into it. We'll be all into it for close to 40. And the single family homes nearby are $100,000 a house. Okay, we're going to be all into the deal for $40,000 a house. And the single family homes nearby $100,000. That's a nice spread. That's a nice gap. But if those single family homes were also $40,000 or $50,000, that would not be attractive. So we really put an emphasis into the single family homes.
That's definitely something we look at too. I think that's a nice way to get you more comfortable about your basis too, that some people don't focus on.
I hope no one steals my secrets. I'm giving you everything I got, Rob.
We don't hold back on this one. So
Cool.
absolutely. Let's jump around to some of these other questions.
Cool.
So you mentioned you get a lot of phone calls, 100 deals in a quarter. Some people would think that's tremendous. Some people think that's overwhelming. Maybe some people who are in the business realize, yeah, that's just the way it is. How do you source most of your deals? And in what format do they get typically submitted to you?
Sure. So I think we're unique. And again, I'm sharing the secrets of Eastham Capital. But so there's myself in the acquisitions. I'm the head of acquisitions, and there's two analysts that work with me as well. When we're not analyzing deals, we are doing outreach to sponsors. And we're saying, hey, we're Eastham Capital. We saw your group. We think there's some synergies between our firms. We think it'd be a wonderful time to set up a call. Looks like we invest in a similar product. I don't know too many other private equity firms around the country who are doing outreach to sponsors. I mean, I would love to get a check from a group like mine saying, hey, I have $1 to $15 million. Let's work together. So we do a lot of outreach, and we've actually sourced a few partners that way. So it's been successful. And then we do the customary, all the conferences. We go to the NMHC conference every January, and we do the speed dating. I think we have 70 meetings in 3 days. We're constantly going to conferences, and we're well connected with a lot of brokers around the area, around the country. So that's how we're sourcing deals. We're trying to make it happen by doing the outbound calls. It's MIH, make it happen.
And what information do you usually see, or more importantly, prefer to see in a deal submission when somebody brings you a deal?
In a perfect world, someone's going to call me up or email me with a quick 2-paragraph summary of the deal, or if they give me a call and they say, hey, here's the quick pitch for the deal, here's the quick 10-minute overview. That's the perfect way to start a deal. And then I would say, I don't need some shiny pitch deck. I just want the meat and potatoes. I want your pro forma. I want your rent roll. I want your trailing 12 profits and loss statement. Maybe your track record as well. But I don't need some shiny deck that's 70 pages. Just give me the meat and potatoes. Give me the numbers. Tell me more about yourself. And if we like the deal, we'll do a phone call. And if we don't like the deal, I like to pride ourselves in being a very quick no within a day or two. I don't want to string anyone along. If I was in a sponsor's position of looking for money, I know how tough that is, how difficult that is, and we want to be sensitive to that. So we are very quick no, and if we are interested, we will ask lots of questions.
I have noticed that and appreciated that. I like the phone call and say, hey, we're a no for these reasons. That's super helpful.
Yeah,
And
and by the way, I think it's important to give reasons too. That way, when you send us deals in the future, you'll understand the deals that we like. But it also shows that we respect you, and we respect that you like this deal and you put work into it. So we should respect you and give you the time and explain why it's not a fit.
absolutely. And when do you prefer to get involved on a deal?
So I think like any company or like any employee or any aspect of work, you evolve over time. So I used to tell people, and I don't know even my rationale back then, but I used to tell people, don't send me a deal until you have it under contract. Well, reflecting years later, how can they really get it under contract if they really can't gauge the equity's interest? So it doesn't really matter when you send me the deal. If you want to send me the deal while you're bidding on it or when you're taking a look at it, it doesn't matter. Send it over whenever. I think we're good guys at Eastham Capital. We're easygoing to a point, but I think we're easy to talk to. Always happy to review deals from anyone. I would say with that caveat, show me deals that you love. Don't show me a deal that you're on the fence about to get my opinion on it, because we'll see right through it. We want to do deals with groups that really are passionate and love the deals that they're pitching.
So going back to skin in the game, you brought up that in your top five.
Yeah,
I think
let's talk about that.
yeah. So skin in the game is very important. I always stress that I can't offer any partnership term. I can't offer any buy, sell, or control rights that speaks louder than skin in the game. It's just the way it is. So one that interesting thing about skin in the game is the rise of co-GP funds or GP capital. And so how do you guys look if a sponsor says we're going to come in with 10% of the equity, yet it's going to come from a syndication of their investor base or from a co-GP vehicle?
So we've never done a deal with a co-GP fund, and I'm not saying we would never, but it's something that we would certainly entertain and discuss internally. And look, different people have different levels of skin in the game, right? So someone who's just starting out, $100,000 or $50,000 is a lot of money for them to invest in one deal. And that's totally appreciated. But someone who's done this for the last 30 years, $100,000 is really not a lot of money. So it all depends on the level of income or wealth the person has, of what material skin in the game they have. So let's say there's a deal, and let's say we invest in it 80-20, 80% Eastham Capital and 20% your company, Rob. The entire 20% does not need to come from you, Rob. We want to see a nice chunk of it come from you, sure. But if you had friends and family who also invested in the deal, who would go to your front door with pitchforks if the deal went bad, we would be okay with that. And again, we've never worked with a GP fund, so to say, not to say we wouldn't, but historically it's been mostly friends and family on the GP side. Or again, if something goes wrong, not only will we be upset with you, but they'll be upset with you as well.
I think that's a great point. And yeah, the co-GP fund, depending on what that looks like, could seem like kind of a cold entity that you don't have a real strong relationship with. Whereas friends and family, I always like to say, that would be an awkward fishing trip with your uncle if he invested in your deal, and you're not doing what you said you would do, or something like that.
And again, I think we would consider a co-GP fund so long as you have material skin in the game.
Definitely makes sense. So now we're talking about different structures, and you mentioned the 80/20. What is your preferred, when you guys are structuring your dream deal, what does it look like from the pref, the promote, and things like that?
So I will be like Bill Belichick and be very vague because every deal is unique and different. So we are pari passu equity, where we would establish a preferred return. Anything over the pref, the sponsor would earn more as being the sponsor. But we don't have one pref. There's different levers for different deals. And I hope that answers your question. I want to give you the best answer I can because, again, we don't really have one deal. And again, we are pari passu. So we would earn same as deal up to the pref. And then over the pref, you would earn more as a sponsor.
Right. And you mentioned your 10% hurdle before. So are you typically an 8 pref, and the 10 is where you're trying to get to your 3, or do you want your pref to be at that 10 hurdle?
I plead the fifth, but no, I plead the fifth on that.
Okay, that makes sense. And then let's talk about, since we were just talking about skin in the game, I think this is also interesting.
And by the way, in terms of an ideal split on a first deal, of course, in a first deal, there's more risk for us and more risk for you as well. We really want to see a lot of skin in the game. I think an ideal first deal is 80/20 or 85/15. And maybe as we get comfortable over time, maybe we move over to 90/10. We've never done a deal 95/5. We've done a deal of 51/49. We've done deals 80/20, 85/15, 70/30, 90/10, but we've never done 95/5.
I hear that a lot. I hear a lot of groups have the most we do on a first deal is 80/20. And then once we know you, we'll do 90/10, we'll do 95/5.
Well, look, I'll give you an example, and it goes back to skin in the game as well. Let's say you did 95/5, or we do 95 and you do 5, right? And let's say you as a sponsor get an acquisition fee. And let's say you also get a management fee and you get an asset management fee. I mean, before you know it, you really have no skin in the game. So what's the risk to you as a sponsor? So we want to see material skin in the game on the first deal.
Yep. So you brought up acquisition fee, which is where I was headed. So when you're looking at skin in the game, I imagine you're looking at it net of fees, right? You can't just say you're putting up 100,000, but then make 100,000, and then you didn't.
Right. And Rob, you'd be surprised how often it happens. And look, if people can raise money that way, then God bless them. But I would say that at Eastham Capital, it's just not going to fly. We certainly take a really hard look at the fees relative to the skin of the game.
So we're kind of getting into some touchy questions. So let's keep going. So what are some questions that you ask to vet a deal and a sponsor real well? Cut right to the chase, and some real tough questions.
So we have an internal checklist. It's 10 pages. So of course, going through our 5 rules to start with, does the deal check all 5 rules? That's the first one. And then going back to what we discussed earlier, we take a hard look at the location and single family home data, location data, rental comp data, all that good stuff. So that's more deal specific. But let's go to the sponsor side. We also have a checklist on the sponsor side. And I would tell you this, really the numbers on a deal are the easy part. It really is. It is what it is. It's very black and white. These are the rents. Here's your debt. Here's the purchase price. But investing with the right group, that's the tough part. So we'll ask for references, and we'll certainly call all of your references. And there was one deal in specific, or one group in specific, and hopefully they're not watching this. And if they are, hopefully things have changed, where we called all of the properties that they owned. And we were just so unimpressed. They didn't pick up, I think they had about 10 properties they owned, and I think 9 of them didn't pick up. One property picked up, and it was an awful phone call. So we'll certainly vet the sponsor by calling all of their properties, and hopefully all those properties pick up, and hopefully they're all excellent phone calls.
That's brilliant. And I'm really glad that you said that, because we're currently brainstorming and strategizing on building out an in-house call center, which would allow our leasing offices to open and I answer calls 24/7.
Yeah,
So,
look, if you were a tenant, it's pretty simple, and you call the property and they don't pick up. The first thing you're going to do as a tenant is you're going to call up the property next door, the other property that you like, and you'll sign a lease with them. And it's so simple. It's just picking up the phone, and it's simple. You can't lose prospects by not picking up the phone. It's such a pet peeve. I hate it. So if a sponsor has really poor management, we're going to be a pass. Even if the deal is great, we'll be a pass on them. And it's happened a few times in my history of Eastham Capital.
all right, and you know what I'm going to ask you now? Can you share those internal checklists?
Oh man, I can't. There's got to be some secret sauce at Eastham Capital. I've already given you. We take a look at the rents. I said, I told you a lot in this phone call. I can't give you the checklist.
Yeah, I could almost put that checklist myself, because you've given up so much information.
It's a lot of it's logic. This business is logic.
It's not rocket science.
Yeah.
For sure. So I think this is an interesting question, which is, what are you out there? I mean, we've gotten a pretty good understanding of what you're looking for, but what are you looking for in the market that you don't see?
So good question. And not every group is like this, but I wish there was more enthusiasm and passion from sponsors buying their deals. If you're going to pitch me a deal, and I'm repeating myself, but really be passionate and enthusiastic about the deal that you're making. It's not just about buying the deal and making money. I mean, you got to think of it like this. You're going to be really impacting people's lives at the property. So I would love someone who's passionate about leasing. I would love someone to show me a deal who's just as passionate about leasing as they are as changing door handles and appliances. That to me would get me excited. I mean, granted, sometimes it's really nice seeing spreadsheets and seeing IRRs north of 25 and 30%, and that's great. But I think what excites me more, and wishing I was able to see more, is really meat and potatoes. Here's our real estate plan. I couldn't be more passionate and excited about this property. Can't wait to lease it up. That's what I would love to see, sitting in our shoes. The quantitative analysis is easy, but really the passion for management and the passion for owning your property, that's how the money's really made.
And I think, to your point that you mentioned earlier, self-management as one of your 5 principles, I think you probably see that a lot more from the vertically integrated firms, because they really have a hand in the management and really know what's going on.
Yeah, but on the other side of the coin, I have a friend in the business who hires third-party management, and he's doing a good job right now. And he's very hands-on. And during this pandemic, he's been very intelligent. He's actually been helping his tenants find jobs, and he's giving them resources of how to find jobs and what benefits they can have from their local government as well. So although he's hiring third-party management, he really has a relationship with the tenants as well. So of course we're biased to self-management, but we understand there's other strategies as well that make sense for other people.
Absolutely. Very cool. Well, I really appreciate your time. This was a great conversation. Like you said earlier, you love for people to bring you deals. So now's a chance to let people know how to get in contact with you if they're a sponsor looking for $1 to $15 million check.
Yeah, anywhere from $1 to $15 million. And again, I think we're pretty easygoing, nice guys at Eastham Capital. I'm always happy to chat deals. I talk to Rob every so often. Always enjoy discussing real estate with him. So if you have a deal, call me anytime. I mean that sincerely. And Rob, thank you for having me. I really enjoyed it.